Coffee is the fastest growing drive-through coffee chain in America, and the NNN investment profile is unlike anything else in the category. Sub 1,000 square foot dual lane drive-through pad. Absolute NNN 15-year lease. Corporate owned, not franchised. And cap rates of 4.5% to 5.25% that reflect growth expectations rather than just current yield. Here's what every investor needs to know about Dutch Bros NNN. Dutch Bros NNN properties trade at 4.5% to 5.25% cap rates, tighter than Starbucks despite lower corporate credit, which reflects the growth premium. The building is remarkably compact, 375 to 1,000 square feet, a purpose-built dual-lane drive-through kiosk with no indoor dining. That tiny footprint sits on 0.4 to 0.6 acres. Entry prices run $1.8 million to $3.5 million. Lease terms are 15 years absolute NNN with 4 5-year renewal options and 10% rent bumps every 5 years. Dutch Bros is a publicly traded company, NYSE BROS, which provides financial transparency that private tenants can't match. Revenue is $1.2 billion plus. S&P credit is B, non-investment grade, reflecting the company's early growth stage rather than financial distress. Dutch Bros is not a bet on a mature, stable company. It's a bet on a growth story at the beginning of its national expansion. The unit economics are exceptional. Dutch Bros generates some of the highest sales per square foot of any food and beverage concept in America from a sub 1,000 square foot building. The dual lane drive-through only format creates operational efficiency that traditional coffee shops can't match. Corporate ownership, unlike Starbucks licensees or QSR franchisees, means every Dutch Bros deal carries the same corporate guarantee with no franchisee credit risk. And the company's expansion trajectory is clear, growing from a West Coast regional chain to a national competitor with 900 plus locations and dozens of new openings per year. Dutch Bros leases are absolute NNN, 15-year initial term. Dutch Bros Inc. a corporate guarantee, all costs on the tenant, including roof and structure. Rent bumps of 10% every 5 years provide income growth. The ultra-compact building is purpose-built for the dual-lane drive-through format. You're not buying a general-purpose retail box, you're buying a custom drive-through coffee kiosk on a small pad site. This is both the stickiness and the re-leasing risk in one fact. 3 things to watch with Dutch Bros. First, S&P B credit is well below investment grade. Dutch Bros is a growth stage company. Revenue is growing, losses are narrowing, but the company is not yet at investment grade financial maturity. The tight cap rates already price in execution success. If growth decelerates or the economics disappoint, cap rates would need to reset. This is a higher risk NNN investment than AutoZone, CVS, or even Taco Bell. Second, the building is highly specialized. A 375 to 1,000 square foot dual lane drive-through structure is not easily converted to another use if Dutch Bros ever vacated. Releasing to another drive-through coffee or beverage concept is the primary alternative. Third, cap rates are tight relative to the credit. You're paying a growth premium. If Dutch Bros hits their expansion targets, current buyers will look prescient. If they don't, investors who bought at 4.5% cap rates will have paid a high price for growth that didn't materialize. Dutch Bros NNN is for investors who want to participate in a legitimate growth story through real estate. The risk is higher than investment grade NNN, but the thesis is real and the unit economics support it. I'm Ryan Solberg with MaxLife Commercial. If you want to look at Dutch Bros NNN properties coming to market in Florida, reach out. Visit maxlifedevelopment.com or call 321-586-2121.